Hi everyone, how are y'all doing? This is me, Yoda again, bringing you a new Q&A. And today we're going to be learning about life insurance. Okay, Monica's here to tell us a little bit about what Transamerica has to offer. And so let's get started. Monica, before we get started, please introduce yourself. Tell us what you do and what you've been doing.
Yeah, thank you. Thank you, Elda, for having me here. So again, my name is Monica Hachey. I'm with Happy Financial Solutions, a Transamerica company. Just to let you know a little bit, we really help people in these wealth accumulation strategies. Of course, we do retirement planning, we do college planning and Head Start planning for the little ones as well. But our niche really is within that wealth accumulation sector.
Okay, awesome. And how long have you been doing this?
My background in finance is a little bit over 12 years. And obviously I'm also in real estate. So that's a little over 7 years at this point. So yeah.
Okay, wow. So also an investor.
Yes.
Okay, awesome. Okay, one of the questions that I have for you. So we already have some questions that we've received in the past. And so one of the questions is, how can life insurance complement and enhance the real estate transaction we handle?
As an agent,
yes,
right?
As an agent.
Yeah, no, that's a great question. So, in the realm of real estate, understanding the value of life insurance in itself is like having a secret weapon, right? Whether our clients are going to be celebrating those financial successes that they have or navigating through debt, they really need to recognize that the influence of money is undeniable. Okay, so let's consider your individual situations, right? And financial as well, right? The well-beings of that, you have to have a solid backup plan. Okay, so just like a well thought out life insurance plan, that's going to provide you immense comfort. Okay, your adequate finances not only secure those present transactions that you have, but they're also going to safeguard any future plans. All right, so this is where you're going to be able to maintain those personal relationships and overall contribute to your client's happier life going forward, right? It's kind of like giving your real estate endeavors a little extra ray of financial sunshine.
Oh, wow. You think of life insurance, and I always thought life insurance is just, for when I pass away and I give something to my family. You never really think of the other things that can actually provide.
Exactly. And life insurance is one of those things, in essence, it is about, making sure that our loved ones are taken care of, right, when we pass away. But it's evolved a lot throughout the years. Yeah. And so much so to where, there's a lot of tax savings that you can apply with that as well.
Oh, wow. That's interesting. Okay, what is the difference between homeowners insurance and mortgage protection, and how does this?
Oh, that's a really, really great question. So people often confuse the two, but homeowners insurance in itself is about protecting the home and the belongings that are within the home, right? So typically if you have something like fire, theft, vandalism, natural disasters, things like that, that's where that homeowner's insurance is going to take place, because that's where that coverage is encompassing the home. Right. Typically, the beneficiary with that is going to be the mortgager. Okay. So, it could be the homeowner, it could be the bank, but, essentially it's whoever owns that mortgage in itself. Right. So you're protecting the asset of the property and its contents and sometimes, personal belongings and things like that, the homeowner. Whereas with mortgage protection, that is more so to ensure that your mortgage is paid off in the event of, say, your death. In some cases, if you become disabled or unemployed as well. All right, so that adds that layer of protection there, so that if you have that outstanding mortgage balance, that's going to provide financial security for your family, right? There'll be a payout for that, because whoever was responsible for making the payments of that, well, now you have that protection, right? And so, it's prudent to have both in place, right? At least on the mortgage protection, you don't need that for typically the entire length of time. It's usually a policy that's covered up to the point where, your mortgage is paid off, essentially.
Okay, which just reminds me that the mortgage insurance that we have on our plan is only to cover the mortgage for the bank. Is that correct?
Correct.
Okay, so that has nothing to do with yourself. So in case of
Right.
anything,
Right. Yeah.
we're still screwed.
Right, exactly. So you think about it, let's just case in point, majority of people, right? There's typically either a primary breadwinner, right? What if something happened to that person? The family will have to either sell their house. Someone might have to go back to work, if they're staying home with the children. What are you going to do in that point? So it puts you in a really bad position, knowing that you'll have that peace of mind that if something did happen, hey, we at least know that our house is going to be paid off and taken care of, and we're going to have a roof over our head, essentially.
Is there usually like a time, like have you had to have this life insurance for X amount of years before that it can actually take place? Let's say I buy the life insurance and for God forbid, something happens to me tomorrow or this week, can it actually be that active that quick?
Yeah, typically it is, right? As long as there's a qualifying event, okay? And so that could be, death, disability, unemployment. You have choices with the policies that you would implement.
Okay. And I'm assuming there's different type of policies.
There are, yep.
Okay.
But I will say mortgage protection in itself, is probably one of the most economical policies that you can implement to have that extra peace of mind.
Yeah. Well, okay. What are some effective financial planning strategies for real estate agents?
For real estate agents, okay. A number of different things, but real estate agents in themselves can, implement different, I would say, financial planning by creating a budget, essentially. That's first and foremost, right? You definitely need to know where that income is coming and going, right? You'll implement a budget. You'll set aside some funds for taxes because, we got to make sure that we have that money saved and put away for that as well. And you also want to establish an emergency fund. Okay, so it's very important to have, if possible, up to a year's worth of what your expenses would be as an emergency fund to help supplement any of that irregular income that we might have, for different market conditions as we are currently experiencing as well.
Yeah. So you also help with that. You also help with the budget?
Yes, I can definitely help people do that.
With your financial experience.
We do complementary financial needs analysis. And so we can definitely take a look at your overall financial picture there. That's a very powerful tool, I think, especially as a real estate agent, right? Because we do have very, cyclical times of seasons here. So,
yeah, especially for us, for some of us that don't know how to save, right? Thank God for my husband working full time. But yeah, this can be very, very beneficial to our agents. How to create a retirement plan that aligns with the fluctuating income in real estate.
Okay, yeah, so that kind of ties into what we just kind of touched on here, but essentially you want to craft a retirement plan, again, that's going to align with that variable income, right? So we can do that in about 3 easy steps here. So, there's numerous steps, but I'm going to give you three quick pointers here. The first one, again, is that baseline budgeting. Very, very important, right? You want to start by establishing a baseline budget that's going to cover all of your essential living expenses. All right, so you definitely need to know what you need to live. And then factor in that average income over the past few years. You want to include both the highs and the lows of that income, okay? Next would be an emergency fund, okay? So again, creating that surplus income just in case. So that financial cushion there is going to help you by building that emergency fund that typically you want somewhere 6 months to a year, but at the very least, give yourself 6 months, okay? That's going to create that buffer for those living expenses. So that's going to act as your safety net there.
Okay, so I have a question. Something came up on my mind. If there's a second income coming in, do you bring them together and see, or do you prefer to separate them? Us as real estate agents, for example, myself, my husband has his, full-time job and we've got benefits and so forth. Do we separate them? Would you advise that they be separated?
Well, typically when I'm dealing with couples, we look at everything on an overall basis together. We don't typically separate that. But if that is your goal, to make sure that, hey, if an emergency occurs and we want to make sure we can survive at least on one income, then, we might not take that additional income into consideration. So then that brings us to the third one, right? So that would be a flexible contribution strategy, essentially. So this is a little bit of my niche here. So given the unpredictable nature of real estate income, right? Because we're talking about you have those highs and those lows. You want to develop a flexible contribution strategy for your retirement accounts. Okay, so definitely, what does that mean? So essentially, during those times where it's prosperous, that's where you're going to contribute as much as you can into that retirement plan. Okay, because that's you want to take advantage of those times where things are nice and meaty in income, right? And then when things are very lean, then that's a point where you would probably adjust that contribution and maybe not contribute as much. Now, one of the things I would say, retirement accounts such as IRAs and 401ks, they're going to have contribution limits. So there's a point to where you can only contribute so much into those. So in that case, you definitely want to max it out. But in the cases of lean periods, well, you may not contribute as much, right? But I feel like at that point, you're kind of missing out on putting anything towards it. So that's where kind of our niche comes into play, because I have amazing products that actually offer a lot more flexibility in this area. And so you would be able to, put way more than your actual contribution limits with the traditional retirement products and still contribute less during lean times.
And if things change within the years, and let's say now I'm making a lot more, double my income, can change happen? Can the plans be different? Can you opt to change from one plan to the other?
So with your traditional retirement plans, like your IRAs and your 401ks, you really will have to keep the money like to like. Okay. Moving money from I would say a non-qualified to qualified, you could present some taxable situations for yourself in that way. Okay. Now, in my specialty of products that I do, that we cover and specialize in, those do offer the greatest amount of flexibility here. There will be limits, but the limits are far greater. And they typically can exceed the amounts that you would have with your traditional retirement account or your IRA.
Okay. Strategies for long-term financial security in the real estate industry. We're talking about long-term.
So strategies for long-term financial security in the real estate industry, right? All right. So that, strategies for that's going to include a couple different things like consistent retirement contributions. Okay. You want to make sure that you're doing this consistently. Make it a habit for savings, right? Pay yourself first. That's one of the things we probably hear, told to us quite often, right? You have to pay yourself first. So you got to think about that. So make that a priority. Another one, it would be wise investment choices. You definitely want to do your research in the things that you're choosing to invest in. Okay, you probably wouldn't want to do something without doing some proper research. And then you definitely have to periodically reassess what those goals are for you, right? You want to make sure that they're still going to be in alignment with how your business is evolving, or even your personal circumstances. If you had a loss of income or something like that, you're going to have to do a reevaluating of your financial picture at that moment too.
Okay. Are there any downfalls in using real estate as your retirement plan?
That's a great question, Elda. As with anything, too much of something can be bad, correct, right? Diversification, I think, is what's key here. Okay. Real estate can be a very valuable component of a well-diversified plan. Okay. But again, it's essential to think about some of those downfalls with it. All right. Number one is going to be market volatility. Having only real estate for your portfolio, real estate markets, they can be cyclical. All right. So we're seeing those highs and lows. They're going to be subject to market fluctuation. Okay. So those economic downturns, that can affect those property values. Okay. What if you needed to retire at that moment in a downturned market? That could be detrimental. That could be the point to where you maybe could retire or not retire, or have to push out that retirement. Okay. Another thing with real estate only is the lack of liquidity. Real estate is not a liquid asset. It's not. So selling a property, that's going to take time, especially if the market is slow. And we're seeing these changes. So this lack of liquidity, that can be a challenge, especially if you're going to need quick access to your cash, for retirement.
Okay. We were talking a little bit about home equity. And I thought this was very interesting that you mentioned instead of getting a home equity, because at one point when you do an application for a home equity, you do need to be available to pay it back. You need to show proof that you're working, that you're getting money consistently. And we talked about getting in an accident, or what if something were to happen to the breadwinner. Tell me a little bit about that. Explain it.
Yeah, so that would be something you definitely want to talk to, your mortgage lender about, or, somebody in that aspect. But the thing to consider about that is you might want to consider possibly getting a line of credit, a HELOC, against your property at a time that you are able to, while you still have that income or employment, and while the values in the property are substantial or high enough for it, right? So obtain that line of credit, even if you're not necessarily going to use it at that moment, but so that possibly if you need to in the future, or sometime further down the line in the future, that you can. Because if you did have an event where you were possibly laid off, you would not be able to get that line of credit anymore.
Right.
So, just something to take into consideration. Yeah. But yeah, no, it's a great point. And then that's kind of brings me into the other things with real estate, being the sole factor for your retirement. You have ongoing expenses with real estate. Property ownership involves cost. Okay. That's going to be those property taxes, maintenance, insurance. Yep. We're all seeing insurance go up quite a bit right now.
Flood insurance, maybe, because everything keeps changing.
Yeah, exactly.
You have a new map every so often.
Yep. So those expenses, that can erode into, any kind of profits that you might have over time, and definitely impact the cash flow as well. Another thing would be market timing risk. The success of a real estate investment, it's going to depend on often the timing of the market, right? Making sure that you buy or sell that property at the right time versus the wrong time, because doing it at the wrong time, then you're not going to achieve the desired returns that you were anticipating or counting on, which that could be a bad situation there. And then last but not least, I would say management responsibilities, right? So, who wants to be a landlord or managing properties while they're in retirement? Most people might not want to. There's probably those occasional people out there that love that. Hey, that's great, more power to them. But, for the most part, you have to think about that, right? Because there's those responsibilities that are going to come into play there. So that requires time, effort, and expertise.
Yeah, not only that, the risks.
Yes.
The risks of having a bad tenant, right?
Exactly. Yeah. And doing something to, the property, in itself.
So let me ask you something. I've heard about this. I think my mother has life insurance, and she's actually borrowed against her life insurance. How does that work?
That is a great question. So essentially, your policies, not every policy, but there are policies that can accumulate a cash value. And so, essentially you could take out a loan against that cash value, or withdraw some of that cash value in itself. All right. So, and that's essentially how that works. So you have that ability. It makes it really nice. It's very flexible. Typically all you really have to do is call up your insurance company, let them know, hey, I'd like to make a withdrawal from my policy. And they usually turn around and, can send you checks pretty quickly with that.
And do they ask for what it's going to be used for?
No, that's one of the great things about that. As long as you have that money there, or that value built up, you're able to withdraw it for whatever reason. So there's not really exclusions on that. You're just limited to what you have available essentially within that policy in itself.
And so, it gets paid back.
Yes, you can pay it back so that your policy can continue to have that accumulation happening there. That's the power of compounding interest. But one of the great things, it's almost like being your own lender or bank,
your own credit card.
Right, or any of those, right?
Yeah.
You don't have to go and make an application at the bank, have your credit run or anything like that. So that's the beauty of that. That's one of the powerful things about those types of products. Now, it's not every product. They're very specific products that have these features. But, if she hasn't, she's able to utilize it. That's great.
Investment property, maybe?
Possibly.
Yeah, okay.
Yeah.
Wow, well, we've learned a lot. Is there anything else you can tell us about your company that's, good for us, that's beneficial for us?
Yeah, no, just one of the things that, again, we have a wide variety of products that we're able to utilize. I am a part of a non-captive broker dealer, so I have a strength in selection there. I have the ability to select over 160 different A-rated companies that are all within our industry. And so it gives me a great power to be able to actually truly sit with people, assess their needs and their wants, and be able to go out there and shop that marketplace to find that best fit for them specifically. Yeah, so my services are free. We don't charge for consultation or management fees as well. So, definitely talk to me if you want a free analysis, and, we can go from there.
Awesome, awesome. She was a speaker at one of our events for the investor gathering. And she did give a whole presentation about all of her products. So if you have any questions about that, about any of the life insurance plans, meet with Monica. And she's great with financials. She knows her financials. Her information will be below. So make sure that you get her information. But just in case, Monica, give us your phone number and your email address.
Yes, so email address, Monica, Monica, at happyfinancialsolutions.com. You can reach me directly at 832-646-0022.
Thank you, guys. Thank you so much for joining. I hope y'all have learned what I've learned. So see you next time. See you next week.
Bye.